Bismillahirrahmanirrahim. This is the first video on recognizing the symptoms of fraud. Understanding symptoms is crucial for detecting and preventing fraud. A deep comprehension of various fraud indicators can greatly enhance the efficiency of fraud detection and prevention measures. We will explore identifying fraud symptoms from 6 different perspectives. This video will cover the first two: role of symptoms in fraud detection and recognizing and interpreting accounting indicators of fraud, while the remaining four will be discussed in subsequent videos. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We will start by examining how Elgin Aircraft managed its healthcare plans and the fraudulent activities that occurred within the claims processing and payment departments. Elgin Aircraft administered its healthcare plans using two distinct departments: claim processing and claim payments. Claims valued at less than 50,000 were managed internally by Elgin Aircraft. However, claims exceeding this threshold were forwarded to an external insurance company. The claims processing department was responsible for validating documentation of payment, after which it was transferred to the claims payment department for approval and disbursement of funds. Elgin's employees could choose between two insurance plans, a HMO plan and a flexible plan. With the HMO plan, employees visited approved doctors within a network for a fixed fee. The flexible plan allowed employees to choose their own doctors, but Elgin only covered 80% of their medical expenses. Management thought their internal control system was excellent. They regularly had different auditors visiting, including government contract auditors, defense auditors, external auditors, and internal auditors. Health claims were processed using a detailed form filled by the treating physician, along with a statement from their office confirming the treatment's nature and cost. This information was then checked by the claims processing department to ensure the payment's employment status within Elgin Aircraft, if the treatments were covered by the plan, that the charges were within approved limits. If individual claims for the year exceeded 50,000, they were sent to the insurance company. The employee's insurance plan and the accuracy payment calculations, once verified, the claims were sent to the payment department. After ensuring the patient is an Elgin Aircraft employee, treatments are covered by the plan, charges are within the approved limits, individual claims don't exceed 50,000 annually. If they do, the insurance company handles them. So, determining the employee's plan and accurate payment calculations, the claims were sent to the payment department, which pays the doctors directly. Employees don't receive any payments. A defense auditor saw the claims payments department manager treating her team to a lavish lunch in a chauffeured limousine. The auditors wondered how the manager could afford such extravagance and if it was being paid for by the government. Upon discussing with the vice president of the finance, he discovered that the manager was highly regarded as one of the company's top employees. Despite never taking a sick day in the past decade, she maintained exceptional work performance and her department was known for its efficiency. The auditor's investigation uncovered that the claims payment department manager had stolen over 12 million from Elgin Aircraft over 4 years. Her fraudulent scheme involved creating 22 fake doctors who would submit medical bills for employees who hadn't received much medical treatment. These fictitious doctors would generate false claim forms which were approved by the claims processing department and then paid out by the claims payment department to the dummy doctors. So the lessons learned are that despite management's belief in their control system, weaknesses allow fraud to occur. Regular audits and oversight are crucial to detect and prevent fraudulent activities. Suspicious behavior, such as lavish spending by employees, should be investigated promptly to prevent potential financial misconduct. Robust verification processes for claims are essential to ensure and prevent fraudulent activities. This includes verifying patient eligibility, treatment coverage, and adherence to approved limits. Organizations should foster a culture of transparency and accountability where employees feel comfortable reporting suspicions of fraud and misconduct without fear of retaliation. Regular reviews and updates to internal control systems and processes are necessary to adapt to changing risk and prevent future occurrences of fraud. Let us see how fraud often goes undetected and how subtle signs can indicate fraudulent activities. Now, fraud is a secretive crime. It often eludes detection as it lacks blatant evidence like a murder or bank robbery. Instead, it reveals itself through subtle signs or red flags, such as changes in the lifestyle, missing documents, or suspicious actions. However, these signs don't conclusively prove fraud, they merely raise suspicions. For instance, lifestyle changes could be due to inheritance, and missing documents may be genuinely lost. So, detecting fraud requires individuals like managers, auditors, and employees to recognize these signs and thoroughly investigate their causes. Unfortunately, many fraud indicators are either ignored or not thoroughly pursued. These signs of fraud fall into six categories: accounting irregularities, weaknesses in internal controls, unusual patterns in data analysis, lavish lifestyles, abnormal behavior, and reports or complaints. These indicators act as warning signals, prompting further inquiry to uncover potential fraudulent activities. First, let us show how these signs could have exposed the fraud at Elgin Aircraft. At Elgin Aircraft, accounting irregularities were evident in the submission of fraudulent claims forms by 22 fictitious doctors. Now, these forms originated from suspicious locations such as a post office box and a business owned by the manager's husband. Payment to these doctors were deposited into the same two bank accounts and bore handwritten endorsements. However, auditors failed to notice these irregularities due to misplaced trust in the perpetrator and a lack of thorough investigation. They overlooked important questions about the reasonableness of payments and the authenticity of endorsements and addresses. Auditors' weaknesses in internal controls, such as managers' extended absence during vacation and the absence of payment confirmations for employees, were disregarded. Fraud prevention measures are implementing independent checks and controls and conducting background checks on new doctors in order to prevent the fraud. Recognizing these control weaknesses and promptly investigating potential exploitation are crucial self steps in detecting and preventing fraud. Analytical anomalies in financial or non financial data signal irregularities that lack logical explanation, such as significant changes in volume, mix, or price. In the case of Elgin Aircraft, several red flags should have prompted suspicion of the fraud. The unusually high volume of insurance work attributed to 22 fictitious doctors, resulting in 12 million in payment over 4 years, stood out. Furthermore, none of these doctors were licensed by the state. Yet they received payments surpassing most legitimate doctors. Another anomaly was the absence of payment from externals, that is, the external insurance companies to these doctors, indicating that none of these payments were for employees exceeding 50,000 in medical expenses annually. Additionally, Elgin's medical cost surged by 29% during the fraud year. Failure to analyze these anomalies can lead to undetected fraud. Analyzing data anomalies is vital for preventing and detecting fraud. Promptly investigating irregularities can help prevent potential fraudulent activities. Thus, analytical anomalies are crucial indicators for spotting fraud. Vigilance and thorough investigation of suspicious patterns are essential. Early detection of anomalies can prevent substantial financial losses and protect reputation. At Elgin, lifestyle symptoms like excessive spending and unexplained personal wealth should have raised concerns. The manager's absence from vacation, despite claiming wealth, was suspicious again. Behavioral signs such as moods and jokes about the manager's behavior were also observed. Surprisingly, there were no employee tips or complaints as other doctors received legitimate business. The fraud was only uncovered when an attentive auditor noticed the anomalies. Next, let us talk about document symptoms in fraud detection. Accounting anomalies often indicate fraud through issues with source documents erroneous journal entries, and inaccuracies in ledgers. Let us examine each one of them in detail. And we start with irregularities in source documents. Now, following are the common fraud symptoms related to source documents. It may be electronic or paper. Recognizing document irregularities is essential for uncovering fraudulent activities. Let us talk about three real fraud cases where documents symptoms indicated potential fraud. These cases illustrate the significance of analyzing source documents in fraud detection. The first case involves the discovery of a large fraud scheme through the examination of photocopied documents, where a vigilant internal auditor noticed a thin line on a photocopied letter in a vendor invoice file, prompting further investigation. The investigation revealed a collusive fraud where the purchase of new equipment was misrepresented as repair costs, leading to financial losses. The letter, originally from a manufacturer, proposed repairing machinery parts as a cost saving measure. However, by removing the paragraph about repair, the purchase of new machinery seemed legitimate. In the second case, fraud was detected by identifying a significant increase in past due accounts receivable, where an accounts receivable manager developed a kickback scheme with a major customer, allowing them to delay the payments in exchange for personal gains. This caused significant financial losses to the company, amounting to 3 million in lost interest. The manager received 350,000 in kickbacks from the customer. The fraud was uncovered when a co-worker noticed a substantial decrease in the company's accounts receivable turnover ratio and conducted further analysis. The third case involves the detection of fraud due to excessive voids or credits in transactions, where a warehouse supervisor manipulated cash transactions by submitting fraudulent credit memos to clear accounts receivable files. Over about a year, the supervisor stole amounts of money, initially submitting 2 to 3 fraudulent credit memos per week, totaling about $100. Gradually, he increased the amount to $300 per week, mixing small and large credit memo amounts to appear random and avoid suspicion. The fraud came to light when the supervisor accidentally credited the wrong customer's account for a cash transaction while he was on vacation. This led to an investigation by accounting personnel uncovering the fraudulent activity. Thus, regular review and analysis of source documents are essential for early detection and prevention of fraud. So, this was the first symptom in fraud detection. The second symptom in fraud detection is faulty journal entries. Accounting, akin to languages like English and Japanese, has its own unique language. For example, legal expenses debit and cash credit. In English, an attorney received 5,000 in cash. In accounting language, debit legal expense and credit cash. Now, fluency in both accounting and English helps understand their identical meaning. Like any language, accounting can be manipulated to deceive. For example, Employee embezzles this 500, disguising it as a legal expense. Such fraudulent entries may go unnoticed, especially if significant legal expenses are regular. Identifying fraud symptoms is crucial to discern truthful journal entries from the fictitious ones. Embezzlers steal assets like cash or inventory and adjust liabilities or equity to hide the theft. Decreasing liabilities by reducing payables can be detected when vendors report delinquent accounts. Smart embezzlers avoid manipulating equity accounts as changes are monitored and required approval require approval. Sorry. Embezzlers balance the accounting equation by increasing the expenses. Increased expenses decrease net income, which reduces retained earnings and owner's equity, keeping the equation balanced. Manipulating expense accounts makes it harder to trace fraudulent activities because expenses are settled at the end of the year. Following are the common journal entry fraud symptoms: lack of documentary support, unexplained adjustments to receivables, payables, revenues, and expenses, unbalanced entries, entries by individuals not typically responsible, entries made near the end of an accounting year. We will showcase these symptoms through three real cases of embezzlement. In the first case, a 150,000 embezzlement was hidden by making unsupported journal entries. John Doe, a small bank controller, embezzled around 150,000 over several years. He did this by calling larger banks and instructing them to pay his personal credit cards. To conduct the fraud, he recorded the shortages as advertising expenses through fictitious journal entries. Now, since the total advertising expenses were substantial, the slight increase caused by this fraud went unnoticed. As the controller responsible for accounting, he didn't even bother forging supporting documents for these entries. His scheme was exposed when he mistakenly deposited a duplicate 10,000 payment from a bank customer into his personal account. Upon realizing the error, the customer requested a refund, leading to the discovery of John's misdeed. If someone had questioned the unsupported journal entries, John's fraud would have been exposed. However, if John hadn't been overly greedy, his fraud might have gone undetected indefinitely. Thus, internal controls, oversights through documentation, and verification processes are integral to preventing and detecting fraudulent activities. Organizations must continuously evaluate and enhance these elements to adapt to evolving risks and maintain a robust anti fraud framework. In the second case, fraudster at Lincoln Savings and Loan used journal entries at accounting period ends to inflate reported net income artificially. For several quarters, large fictitious revenues were recorded, shifting Lincoln Savings and Loans from a loss to a profit position. After the fraud was uncovered, the accounting firm reviewing Lincoln's transaction found that 13 transactions had overstated income by more than 100 million. Investigative auditors described these transactions as the most severe application of accounting they had ever encountered. This case underscores the importance of vigilance in detecting irregularities in financial positions or financial transactions. So, fraudster exploited journal entries at the end of accounting periods to manipulate reported net income, artificially boosting the company's financial position. So, despite the magnitude of the fraud, it could have been detected earlier if auditors and regulators had recognized the pattern of last minute entries. Through scrutiny of financial state transactions and timely detection by auditors and regulators are crucial in preventing fraud and safeguarding investors' interest. At Waste Management Corporation, the CFO realized that the external auditors only conducted detailed audits on the annual financial statements with only a brief review at the end of each quarter. To inflate net income, at the end of each quarter, the CFO made simple top side journal entries. These entries increased accounts receivable and revenue, creating a false appearance of increased income. Top side journal entries are last minute adjustments made to financial figures at the end of a reporting period without proper documentation. They are used to manipulate financial statements like boosting revenues or assets to give a false impression of a company's financial status. These entries impact crucial figures such as revenue and net income, but are often made without any backup or real transactions. This lack of support can signal fraud or financial mismanagement. These entries grew larger each quarter but were reversed at the start of the next quarter. At the end of the year, the fraudulent entries were hidden within complex merger reserve accounts. These type of frauds involve unsupported top-side entries was widespread among several companies in the 1990s. So the lesson learned is that in the case of this waste management case, it highlights the necessity of vigilant oversight and examination of financial records to safeguard against fraudulent activities, ensuring the integrity of financial reporting. The third symptom in fraud detection is inaccuracies in ledgers. Ledgers serve as a record of all transactions related to specific accounts such as cash or inventory. The accuracy of ledger balances is crucial, often verified by ensuring that total assets is equal to total liabilities and equity, or that debit balances equal credit balances. Fraudulent activities often involve manipulation of receivables from customers or payables to vendors. Two common ledger fraud symptoms include unbalanced ledger. That is, total debt balances do not equal total credit balances, indicating incomplete cover up in accounting records. For instance, embezzled inventory may not be reflected accurately, causing discrepancies between recorded and actual inventory level. Then discrepancies in master account balances. Now, master receivable or payable account balances do not match the sum of individual customer or vendor balances, suggesting manipulation of individual balances without altering master accounts. For instance, in a small bank, a bookkeeper perpetrated fraud by manipulating individual customer balances without adjusting the master account balances. The discrepancy in ledger balances expose the fraudulent activity. Thus, identifying these symptoms is vital for detecting and preventing fraud. And so, these were the three main areas of accounting anomalies that included irregularities in source documentation, faulty journal entries, and inaccuracies in the ledger. So, this completes the first video on recognizing the symptoms of fraud. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.